Hello everyone, welcome to the second video and the second lecture of the Quantitative Trading Strategies course. So in this video, we're going to cover the limit order and specifically what is a limit order book. All right, so let's get started. First, a limit order, it is an order that instructs the broker to buy or sell at the best price available in the market. And there's a condition here. So only if the price is lower than the price limit specified by the investor. So it's a mouthful, but let's look at one example. So suppose this is the price ladder, and this is low price, this is high price, and different price units here. So if I set a limit here, so this becomes a limit order to say, I want to buy an asset, right? I want to enter into a buy limit order only if the price is at this range. So at this range, right? This means that if the price of the asset drops below this threshold, then my limit order triggers. Then immediately it will become a market order, and then enter into the markets, and then if there's a match, then it will trade, right? But if the price fluctuates along this range, right? So this is a range where the limit order will not get executed, will not get triggered. So this means that if you place a limit order, there's a risk that this order will never be executed. All right. So now, why is it available in the market? Because it's mostly used for buying or selling less frequently traded assets or highly volatile assets, right? So you want to avoid the risk of floating prices. You want to control on the price you would trade when you buy or sell an assets, right? So it's more for controlling the assets by adding this if condition. So there's a if condition here. A buy limit order, as the name suggests, is an order to buy an asset, right, at or below this specified price. So you would specify the price along with the quantity, and then it will be a standing limit order in the market, and specifically it will be displayed as part of the limit order book for the assets. All right, so it's mainly used to control how much we have to pay for the instrument. And correspondingly, we have sell limit order, right? Sell limit order, where the investor can use this type of order to sell a financial asset at or above a specified selling price. So when you sell something, right, you want the price to be as high as possible, right? But of course, there's a competition in the market, so you want to control the selling price, then this is the type of order you can place. All right, so limit order book, right? So what is a limit order book? It is a book that contains a lot of limit orders, right, for a specific asset. So basically, it consolidates all the standing limit orders. So by standing, I mean if a limit order becomes a market order because the underlying condition, the if condition is triggered, then it will become a market order. Then if it gets executed, right, gets fulfilled, then it will disappear from the limit order book. So in other words, the limit order book includes all the standing limit orders, right? And it includes both sides, the buy side and the sell side. So this is the buy side. Sorry, this is the sell side. This is demand side or buy side, right? And as a market maker, the exchange, right, it is incentivized to reduce the gap, right? So this is a gap, and provide more liquidity to the market. So let's try to understand the graph on the right side. So we put an axis here. So this is vertical axis, and this is the price P, right? So the price increases. Here the price is very low, and here the price is very high for a specific asset. And the reason is because people's evaluation for the asset is different, right? Some people wants to buy cheap, some people wants to buy give it a bit higher price. So if I want to buy cheap, then I would place a limit order here because if the price drops, right, at below this threshold, so at or below this threshold, then my order activates. I would enter into the market. But if that's not the case, then I will be having my order standing in the limit order book, right? So, and continuously check if the price drops below this level. All right. So, and then different people have different price evaluations, and we have different points at the price ladder. So this is a price ladder, and all these beats form the demand side, which is the buy side, right? So this is the buy side, and then the upper tier, we have the different people who are willing to sell the assets at different prices. So some people, some investors are willing to sell at a high price, at a low price, right? And the most characteristic price point is this one. So this is the price point corresponds to here. This is called the best offer or best ask. So I'm selling something, I want to ask for a price. Now this is the best ask, meaning that it is the lowest asking price of all the available prices from the supply side, right? So of course, if so want to for the buy side, for the demand side, we want to buy as cheap as possible. Then this means this is the most attractive price point among all the available offers in the market. And similarly, we have different buyers and different people are willing to buy at different prices. So the most attractive bids are it would be the price point that is the highest among all the available bids, right? So this is the so-called best bids. So we have the best bids and we have the best offer or best ask. And there's a gap here. And the gap is because one, exactly the reason why the asset itself is less frequent, right? It's not a popular asset people would usually treat often, or it's highly volatile, right? It's highly volatile. So there's a spread here, and the spread is exactly the difference between the best offer and the best bid. So of course you can tell two things from here. So one is if the gap is very big, that means that people's assessment, people's evaluations are very different, right? So that means that makes this asset very less volatile, right? Less frequent, so less liquid to be exact. The other thing is that if the gap is very small, and what happens if my best bids continues to increase, my best offer continues to decrease, then eventually they will cross over, right? So what happens when it cross over? Then there will be trigger points, right? So because the price moves, and then there will be someone who are willing to sell for low price, who are willing to buy for high price. And when these two forces converges, right? For example, this point, then they actually enter into the market. So both will enter into the market and then transact, because the conditions triggered and the supply side and the sell side have an agreed price to transact against each other, right? Then that means that this transaction it happens and it will be removed from the limit order book, right? So then we'll have another new gap. So this is what happens. All right. So of course, the goal of the market maker is to make this spread as small as possible, so that it is more likely for people to trade and for the assets to move around. All right. So that's it for the limit order book, and we can look at the limit order book from another angle, which is called the marketability, right? So we have the marketability of the sell orders and the buy orders. So what is a marketability? It is how marketable you are when you enter into a limit order. right? Can be a sell side, can be a buy side. So let's look at the sell side first. Maybe a buy side first. So if I have a buy order, right? I want to buy something and at some price. So this price, of course, I want to be as low as possible, right? But there are different cases here. So I have enumerated 5 cases here. Depending on how high or how low my price limit is. So the price I set for the limit order is. So okay, let's look at the first case. First case means that I have a buy limit order. I want to buy something if the price reaches that threshold or better, right? And this price you see is quite high, right? What does it mean? So this is again the price axis, and then this is from very low to very high. So at this point, the price is very high, means that I want to buy something and I'm not very sensitive to the price. So even if the price is very, very high for those sellers, I'm still willing to buy. So this, in other words, the limit order, the buy limit order I place in the market is very marketable, right? Very marketable. I'm very insensitive to the price. So that's the type of marketability for this type of order. The second case is when my price is at this point, which is the price of the best offer, right, from the supply side. Again, it is marketable because even if it's a bit lower than the first case, it's still marketable. It is still transactable, right? It's still tradable because I can immediately find a seller who is willing to enter into the transaction, right? Okay, so the third case is called in the market. Why is that the case? Because in this uncertain range, right? So this range is uncertain. I cannot guarantee it will be executed or not, right? So unless there's a new seller willing to lower the selling price and then reduce the spread. So this is in the market, right? So anything can happen, either it gets fulfilled or not fulfilled. So that's the third case. The fourth case is continue to drop the bids, the bidding price, and then this is called at the market. When my price is just the best bids, the highest bidding price of all the bidders, right? Of course, this is the best in the market in terms of from the buy side, right? So I'm offering the price that is highest among all the buy side traders, right? And it represents the best bid of the limit order book. So it is called at the market, exactly at this best bid price. So all the other price points are so-called behind the market because as a buyer who enters the market, and there's no competitive advantage in terms of the price, the bids I place on the market, because there'll always be someone else who are willing to pay higher for the same assets, right? So this is called behind the market. So corresponding, we can apply the similar line of reasoning for the sell sides in terms of marketability, right? So if my selling price is very high, it's not really attractive for the potential buyers, then it's behind the market, then gradually at the market, in the markets, until it is marketable. Marketable means that I can always find the buyer from the buy side to transact with me. So it is highly marketable, right, within this range because my selling price is so low. Okay, so that's the characteristic of in terms of marketability. Lastly, let's look at one more type of order, which is called either way display or not display the order. So a display order is visible, right? It is visible in terms of what we see on the limit order book. A non-display order is still an order, but it is hidden, right? It's not displayed on the limit order book because remember, when we place an order, we can choose how much order we want to expose to the markets, right? We may not necessarily want to say, oh, I want to transact a lot of orders, place a lot of orders. So this may create reactions from the market. So And of course, we talk about precedence of execution. So non-display order comes after display order in terms of sequence of execution, right? When the order is visible, and usually the exchange would prohibit from locking or crossing the market. So what this means is that if I have an exchange that has this bid or ask price point for this asset, then another exchange, right? They cannot come to compete with me. Otherwise, the markets will be spoiled. Right? So you do not necessarily want to have impacts. You have impacts from other markets, right? So in other words, once the order is visible, then it has to be locked or crossed within the respective markets. Right. So that's again to avoid the disruptions from different exchanges. So these regulations again ensures that the bid ask spread stands for a particular asset. Right. Okay, so that's it for this video, and thanks for watching, and I'll see you in the next video.